Hello there. Today I want to discuss the concept of fair value gap. It is common on our chart, but a lot of people find it difficult to use it effectively for their own advantage. So let me discuss what is fair value gap and how to spot it on your chart. A fair value gap happens when there is an inefficiency in the market. Inefficiency in the sense that the amount of buyers or the seller in the market at a particular time outweighs one. You understand? Maybe in a bullish fair value gap, for instance, it means that the buyers are much higher than the sellers in the market. So in that case, you will see that there's a gap that is left behind in a bullish movement. So let's go to the chart. Let me show you how you can spot this movement on your chart. So this is fair value gap happening right here. We have a bullish fair value gap. And why is it bullish fair value gap? It is bullish fair value gap in the sense that in the set of these three bullish candles, there's a gap in between the first and the third candle. The gap happens between the third and the last candle. If the wick of this third candle overlaps the first candle, it is no longer a fair value gap. It is a complete and a balanced market. But in this case, there's a fair value gap. You understand? So if there's a fair value gap, the price tends to return back to this zone. You understand? And you want to see the price return back to the 50% level of the fair value gap. Where can you find the 50% level? You can use your Fibonacci tool to actually mark it. And if you want me to do another video to show you how to use your Fibonacci level to mark your middle point of the fair value gap, because that middle point is very important. It is that particular point that the market tend to change. So if you are expecting the market to change from your fair value gap, it is important to watch that 50% level. You understand? That 50% level, 80% of the time, if the market want to continue the trend, it will change from that place. So you want to keep your eye on that place and check for any confirmation candlestick. You understand? And you don't just use your fair value gap alone. You have to match it with other conferences before you can use your fair value gap. When is fair value gap most likely to work? It is most likely to work when there's a break of structure with the fair value gap. And you can see in this scenario, the market, let's say the market is trending upward, forming a series of higher highs and higher low. In this case, it dips. You understand? It formed a higher low, a higher low. You understand? And the market push upward again. And this upward movement breaks this structure here. So when the market breaks a structure with a fair value gap, that right there is a strong fair value gap, and you want to wait for price to return to that zone again. Then you can ride it to the upside. So this is it guys. If you want to master your fair value gap, these are the things that you should put into consideration. First off, it should break a structure. When the fair value gap happens, it should break a clear structure in the market, so that you know that okay, a trend shift is about to happen, or continuation is still strong in the market. So you want to mark your 50% level of the fair value gap, just like I demonstrated to you. You can use in this chart, I'm using a mirror dashboard to demonstrate the fair value concept. But if I want to use my chart, I can use my chart. So let's go to the chart so that I will show you how to mark your 50% level on the chart. So this right here is Euro, GBP USD, you understand? And you can see a fair value gap here. So this is a fair value gap right here. The last candle and this third candle does not what? The gap does not match. You understand? The gap does not overlap each other. The gap does not overlap each other. You understand? So this is a fair value gap right here. So this is a fair value gap. So this is the fair value gap. So to mark the midpoint of this fair value gap, you want to carry your Fibonacci retracement, start from this point, the point that are marked as your fair value gap, the point between this place and this other candle, the wick of this third candle. So you want to draw your Fibonacci level to this place, you understand? So when the market reaches the 50% zone, you understand, then you can look for maybe short opportunity to short the market downward again, you understand, because you can see clearly the market after this fair value formation, we discover that the market broke structure here. You can see it broke structure clearly on the charts. This is the structure that it breaks rather. So this is it, this is the structure, this is the structure that the market breaks. And if you are expecting a continuation of this trend, you want to wait for the price to return back to this level. Definitely it will return. It may not happen fast, but 80% of the time it will definitely return back to this zone. So when the market returns to this zone, you want to position yourself and look for any conferences or any candlestick that shows a bearish momentum, then you can ride the market downward. So guys, this is what I have for you, and if you are new to trading and you want to learn more, you can join my community so that we can share knowledge together. And if you are looking for a broker to use, you can check the description of this box of description box, and you see a broker for you that I've been using for the past how many years now. So guys, thank you for joining me again.